Basically what it does is it allows for exclusion of gain. And I actually had a client who availed themselves of it. They set up a manufacturing business in Michigan. We set them up about 8 years ago. And in 2024, they were acquired by a venture capital company. And my client owned 30% of the business. And he got $9.5 million. And since this was a qualifying small business, that $9.5 million he received came out totally federal tax free. Okay, that's about a $3 million tax savings. He did have to pay Michigan tax, but that was a few $100,000. But again, it's a very powerful code section to use. And basically the OPBA came up with liberalization and made it more attractive for businesses. Under the old rule, it was a strict 5-year holding period. You had to hold the stock for a minimum of 5 years. The exclusion was capped at $10 million or 10 times the taxpayer's basis in the stock. And the asset cap of the company was $50 million. OBBB changed that for stock acquired after July 4, 2025. Now, these new rules only apply prospectively for any businesses set up prior to July 4, 2025. The old rules still apply. And basically, the new rules provide for a tiered structure so that stock held less than 3 years, at least 3 years, but less than 4, the exclusion is 50%. At 4 years, it's 75%. And at 5 years, there's a full 100% exclusion of the gain at the federal level. Now, as an example, stock acquired on January 1, 2026 would qualify for the 50% exclusion if the stock was sold on January 1, 2029, 75% exclusion if the stock was sold on January 1, 2030, and 100% exclusion if it was sold after January 1, 2031. The increased gain exclusion has been increased from 10 million to 15 million for years stock acquired after July 4, 2025. The cap on company assets has been increased from from 50 million to $75 million, so that if you have, let's say somebody coming in venture capital, the change expands the limit so that the new limitation of 50 million is increased to 75 million. Okay, but again, the basic requirement, it must be a C Corp, can't be an LLC, can't be an S Corp, and then it has to be a corporation that's engaged in an active trade of business. It excludes service businesses like law, finance, hospitality. It excludes artists, professionals, things like that. So again, when you're advising your clients, a lot of times accountants say, set up your business as an LLC, you get the pass-through of any losses. You may want to consider whether it's worth that when you have to consider the potential exclusion of gain, which could be up to $15 million. The ability to use stacking is still in the law now, notwithstanding what the slide says. The stacking allows you to transfer shares from myself to trust for my children. As long as it's a non-grantor trust, each of those recipients qualify for the $15 million exclusion. That means you can magnify what your exclusion is for taxes. give you an example here. An investor who buys qualified business stock for $100,000 on August 1, 2025, and sells it for $2.1 million 3 years later. The resulting $2 million gain, 50% of that qualifies for the exclusion. We have a tax on only $1 million. Savings could be $300,000. New Jersey has adopted the 1202 provisions. New York has. I know a number of other states have. So again, it can be a significant impact for federal and state purposes. Let's take an example of a startup with $45 million in assets, and venture capital comes in with $30 million of additional revenue. So now our total capital base is $75 million. We still qualify for 1202 because we're under the new exemption limit. Under the old rules, the $50 million threshold would apply. Under the new rules, the $75 million exemption applies. And again, the 3-year, 4-year, and 5-year holding periods apply to determine the exclusion again. Again, I encourage advisors to discuss with your clients whether you want to be an LLC or a C Corp. The advantages of a C Corp: 1, C Corp is in the lower federal income tax bracket. It pays only a 21% tax. Typically, the shareholders are personally in a higher tax bracket than in a C Corp. And if you go to sell or you have a monetization event with proper structuring, the gains up to $15 million can be totally excluded from federal purposes and New Jersey tax purposes. New York, I haven't checked all the other states, but again, it's something to keep in mind when you're doing your planning. Thank you.